Welcome to the deep dive. The S&P 500, it's always there in the headlines, right? But what's really going on underneath? Today, we're aiming to cut through some of that noise. Our mission is a real deep dive into the S&P 500's earnings, its valuation right now, and this, well, powerful but definitely concentrated AI-driven market. This is as of September 12th, 2025. We want to help you see beyond just the daily ticker changes.
Exactly. And there's this central tension we really need to unpack today. On one hand, you've got this incredibly compelling growth story, and it's heavily, heavily fueled by AI. But on the other hand, you're looking at some very clear risks, historically high valuations, and a lot of the market's performance concentrated in just a few places. It's a bit of a high-wire act.
Okay, yeah, let's unpack that. So this powerful growth narrative for the S&P 500, the numbers look impressive, but then, like you said, you look at the valuation, how the market's priced, and there's this, I don't know, tension feels like the right word. Are investors basically paying a premium for all that expected growth?
Precisely. I mean, the consensus forecast shows really robust earnings per share EPS growth. We're talking an expected 10.7% for fiscal year 2025. And looking further out, even stronger, maybe 13.7% for fiscal year 2026. But here's the key thing. This optimism, it's overwhelmingly being driven by this potent but highly concentrated AI investment supercycle. It's mostly boosting just two sectors, information technology and communication services, so it's very specific growth.
And it's not just the raw numbers, is it? You mentioned the analyst sentiment seems unusually positive. Wall Street's actually revising future earnings estimates up. That feels different. Usually they turn those down, right?
They often do, yeah. So seeing upward revisions is definitely a positive signal. It suggests, genuine conviction. However, you absolutely have to see this optimism against the backdrop of these historically elevated valuations. The S&P 500's forward 12-month PE ratio, the price to earnings, is sitting at 22.5. Now, put that in context, it's quite a bit higher than the 5-year average of 19.9 and even more of a premium over the 10-year average of 18.5. So what that means is investors have really high expectations baked in already. They're betting on things going, well, almost perfectly.
Okay, so paying a premium, betting on perfect. But what exactly are they buying with that premium? Let's get into the nitty-gritty a bit. These projected earnings, the revenue numbers, what's the near-term outlook really look like? And the full year?
Okay, diving into the specifics. For Q3 2025, the quarter we're kind of looking at now, the market's expecting year-over-year EPS growth of about 7.6%. That's on roughly 6.2% revenue growth. Now, if that happens, it'd be the 9th straight quarter of positive year-over-year earnings growth. That tells you something about corporate resilience, right?
9 quarters, yeah. That's pretty solid.
It is. And looking ahead to Q4 2025, the forecasts are pretty consistent. Around 7.3% EPS growth, 6.4% revenue growth. For the full calendar year 2025, analysts see a return to double-digit earnings growth specifically, looking like plus 10.7% EPS on about 6.1% revenue. And then 2026, like I mentioned, even more optimistic. Plus 13.7% EPS growth, but on only 6.5% revenue growth. These bottom-up EPS estimates, they've actually been nudged up recently. For FY25, they're somewhere between, say, $268.50 and $269.50. And for FY26, around $303.88.
Wow, those 2026 numbers really jump out, that 13.7% EPS growth and only 6.5% revenue growth. That implies something more fundamental is shifting, right? It's not just selling more stuff. How does that work? Profitability must be exploding.
You've nailed a critical point there. It points directly to profit margins.
Yeah.
So let's look. The blended net profit margin for the S&P 500 was about 12.3% in Q2 2025. Projections see it rising maybe 12.7% for Q3, 12.8% for Q4. That gives you an implied full-year 2025 margin around 12.6%, which, by the way, is already above the 5-year average of 11.8%.
Okay, so margin's already improving.
Yes, but 2026 is where it gets really interesting, like you said. Getting EPS growth more than double revenue growth. Mathematically, that really only happens two ways, either through significant net profit margin expansion or just massive share buybacks, reducing the share count. The core assumption here seems to be that margins will expand quite a bit, maybe towards 13.5%.
And what drives that kind of margin expansion?
Well, it's likely a mix. Operating leverage, basically, fixed costs get spread over more sales, so profits grow faster than revenue. Plus, potential AI-driven productivity gains finally showing up, and of course, the growing influence of the high-margin tech sector itself. But it is a bold assumption. It's definitely sensitive to things like, unexpected wage hikes or
Mm.
another commodity price surge.
Right. So the big picture numbers look good, but driven by these specific factors. But the S&P 500, it's not just one thing, is it? Feels like these overall numbers must be hiding a big split, a bifurcation you called it, between different sectors. So who are the actual superstars pulling the weight and who's, well, dragging things down?
You're absolutely right. The strength is very concentrated. Looking at FY 2025 estimates, communication services is projected for a, frankly, staggering plus 48.0% EPS growth.
48%.
Yeah, and that's almost entirely driven by the mega caps. Think Meta, Alphabet. They're benefiting from digital ads bouncing back and starting to make money from generative AI. Then you have information technology. Expected growth plus 23.0% EPS. This is really the heart of the AI story. It's just relentless global demand for the building blocks of AI semiconductors, software, cloud infrastructure. That's why it also has the highest projected revenue growth, 13.1%. And third, financials. They're looking solid too, around plus 12.0% EPS growth.
Okay, what's helping them?
Well, the economy's holding up, which keeps loan losses manageable. Plus, we're seeing a sharp rebound in capital market stuff, M&A, IPOs, which generates fees for them. It's worth noting that revenue growth looks negative 2.7%, but that's mostly just tricky year-over-year comparisons, not really a sign of weakness today.
Okay, so that's the engine room, comms, services, IT, financials. But then there's the other side of the coin. A big chunk of the index must be struggling if the overall average is only around 10.7% growth. Who's facing the headwinds?
Right. At the bottom of the pile, you've got energy. Projected EPS growth is actually negative, minus a 19.0%.
Minus 19. Ouch.
Yeah, they're dealing with really tough comparisons to last year's commodity prices. Oil and natural gas prices are down, and that hits their revenues and margins directly. They were actually the only sector with falling revenues year over year back in Q2. Then there's consumer staples, also slightly negative, maybe 1.8 to 1.6% EPS growth.
Staples. Usually they're defensive. What's going on there?
Significant margin pressure. Input costs are still elevated, and they're finding it hard to raise prices. Much more consumers are tired of inflation. Plus, tariffs keep getting mentioned on their earnings calls. And finally, materials, down slightly, maybe near 1.8% EPS. That seems mostly due to ongoing weakness in chemicals tied to a kind of sluggish global manufacturing picture. So yeah, it really is a tale of two markets within the one index.
It really is. And thinking about those winners and losers, it strikes me this AI boom, it's creating demand in some really unexpected places, isn't it? I heard something about utilities.
Yes. There's a really interesting sort of second-order effect. Utilities. Think about the sheer amount of power needed for AI. Training these huge language models, running massive data centers, it's creating a brand new, powerful source of demand for electricity.
Right, all those servers need juice.
A lot of juice. We're seeing companies like American Electric Power talking about boosting their 5-year capital spending plans by 30%. They're forecasting maybe a 60% jump in peak power load by 2030.
Hmm.
I heard one executive say the demand growth is like nothing he's seen in his 45-year career.
Wow, that fundamentally changes things for utilities, doesn't it?
Absolutely. It shifts the whole investment story from being seen as this, low growth, maybe boringly defensive sector to potentially a long-term growth story. Quite a pivot.
Talk about a pivot. And speaking of shifting stories, you mentioned earlier that analyst sentiment has taken this markedly positive direction. That seems unusual. What does that really tell us about the mood out there beyond just the forecasts?
Yeah, that shift is significant and definitely not the typical pattern. So over the last 90 days or so, say from late June to late August, the overall FY 2025 EPS estimate for the S&P 500 actually increased by 1.6%. Now, normally during a quarter, analysts tend to trim estimates down maybe by 1.4% on average over 5 years, or even 3.2% over 10 years.
So instead of trimming, they're actually raising the bar.
Exactly. It suggests this isn't just companies beating lowered expectations. It's more like a beat and raise happening at the index level. Wow. Genuine strength, what's driving it, seems to be, fewer worries about the macro picture. We're hearing less about tariffs, inflation, recession on earnings calls, and real fundamental strength, particularly in tech like we discussed. Another indicator, the earnings revision breadth. About 53% of S&P 500 companies actually issue positive guidance for Q3. That's way stronger than the historical average, which is usually closer to 39–43%. So the optimism is pretty broad-based, at least in terms of guidance.
Okay, but presumably that positive revision trend isn't hitting every sector equally. Where are analysts feeling most confident?
No, you're right. It's not uniform. The big positive revisions have been in communication services, again, up 4.0%. Financials estimates up 3.3%, and consumer discretionary up 3.0%. On the flip side, the biggest negative revision was actually in healthcare, down about 2.1%. It seems mostly due to some deceleration in their earnings growth. So yeah, clear leaders and laggards in sentiment too.
Okay, so if we try and pull all these threads together,
Mhm.
what's the main story? What's the dominant narrative for the S&P 500 right now? The big catalysts, the big headwinds.
The primary narrative, really the dominant force, has to be the transformative impact of AI. Artificial intelligence is creating this massive capital spending cycle.
Yeah.
You can see it clearly. Mentions of AI on earnings calls are at a 10-year high. And this AI growth story is happening against the backdrop of a pretty resilient U.S. economy, which more and more people are calling a soft landing. That combination is powerful.
Right.
So for the top sectors, the AI investment cycle is the direct catalyst for IT and communication services. And that creates that stark split, that bifurcation we talked about. The Magnificent Seven or Grade 8 tech stocks saw their 2025 EPS estimates go up 3.5%, while the estimates for the other 492 stocks actually got cut by 3.8%.
Wow, that's a huge divergence.
It really is.
Yeah.
And for financials, the catalysts are different. The resilient consumer may be a steepening yield curve, which helps their lending margins, and that pickup in M&A and IPOs.
And the headwinds, what's holding back those other sectors, creating that other side of the market?
For the laggards, the challenges are pretty clear. Energy is still dealing with volatile, mostly lower commodity prices.
Right.
Consumer staples and materials, they're fighting those persistent margin pressures, high input costs, maybe tariffs still biting. And then you have sectors like real estate, very sensitive to interest rates. High rates just make borrowing more expensive and make their dividend yields look less attractive next to other options. So yeah, while AI is boosting the top, traditional economic factors are definitely weighing on others.
Okay, we started off talking about those elevated valuations. Let's circle back and really dig in there. What does it mean in historical terms? Are investors just paying so much for this growth that there's basically no room left for anything to go wrong?
That's a really good way to put it, yeah. That forward 12-month PE of 22.5x, it is trading at a significant premium. Like we said, it's well above the 5-year, 10-year, even the 25-year average PE ratio. So historically speaking, the market looks expensive, pretty much however you slice it recently. And another way to look at it is the PEG ratio, price earnings to growth. You take that forward PE of 22.5 divided by the expected FY 2026 growth rate of, say, 13.7%. That gives you an implied PEG ratio of about 1.64.
And what does 1.64 mean? Is that good, bad?
Well, the traditional rule of thumb is that a PEG ratio around 1.0 suggests fair value. So 1.64 is significantly above that. It suggests investors are paying, well, quite a full price for that anticipated growth. High expectations are definitely factored in.
So the overall market seems pricey, but does that apply everywhere? Is every sector expensive, or are there still some corners that look maybe reasonably valued?
Oh, definitely not everywhere. You see extremes. Real estate, IT, consumer discretionary, they have the highest forward PE ratios. We're talking maybe 28x up to 34x.
Okay, so they're priced for perfection, basically. High growth expected.
That's exactly. Price for robust long-term growth, which also means potentially higher risk if that growth doesn't materialize. But then you look at energy, financials, utilities. Their PE ratios are much lower, maybe in the 15x to 16x range. They're trading at a pretty substantial valuation discount compared to the market leaders. So yeah, maybe some opportunities there for investors looking for value or a different kind of exposure.
This next point feels really critical, especially for anyone thinking about income right now. This idea you mentioned, Tiara, there is a reasonable alternative. That feels like a fundamental shift. It's not just about picking stocks anymore. It's justifying stock risk at all versus a safe bond yield.
You've absolutely hit on a fundamental change in the landscape. It's huge. Right now, the S&P 500's dividend yield is hovering around 1.25%. Just 1.25%. Compare that to the yield on a risk-free 10-year U.S. Treasury bond, which is, say, 4.06%.
Big difference.
Massive difference. This is the opposite of the post-2008 world, the TINA era. There is no alternative. When bond yields were so low, investors felt forced into stocks for any kind of return. Now, with TR, there's a reasonable alternative. That 10-year Treasury offers a yield pickup of about 281 basis points, 2.81% over the S&P 500 dividend.
So why take the stock risk then?
Well, that's the question. For investors to choose equities now, they need a really high degree of conviction that they'll get capital appreciation, stock price gains to make up for that big yield disadvantage. And, of course, to compensate for the extra risk you always take with stocks versus government bonds. It just fundamentally increases the risk premium, the hurdle rate, for investing in equities today. makes the decision much tougher.
Okay, so tougher decisions. And we're forecasting, what was it, nearly 14% EPS growth for 2026? That sounds big.
Yeah.
How does that stack up historically? Has the S&P 500 often delivered that kind of growth? Are we forecasting something truly unusual here?
It is a pretty significant number, yeah. That 13.7% forecast for 2026 earnings growth. It's a definite acceleration from the historical norms. If you look back over the past decade, say 2012 to 2021, the average annual EPS growth rate for the S&P 500 was closer to 7.8%. Even if you just take the last 5 years of that period, it was around 8.6%.
So 13.7% is way above that.
Way above. It really underscores just how high the expectations are that are baked into current market prices.
Hmm.
It reflects the strong belief analysts have in, well, the AI productivity boom really kicking in, that soft landing story holding true.
Right. Exceptionally high expectations. So given that, what are the key things, good or bad, that could actually change this earnings path? What should listeners maybe keep an eye on? What are the big risks or potential upsides to this whole forecast?
Okay, yeah, let's look at both sides. On the upside, what could make things even better? Well, one possibility is that AI adoption broadens out faster than expected. The productivity gains spread beyond just the mega caps to the rest of the market, the S&P 493, if you will. That would make growth less concentrated, maybe more durable.
Okay, broader growth. What else?
Another one would be more aggressive easing from the Federal Reserve. If inflation falls faster, maybe they cut rates quicker or deeper than expected. That's almost always a direct tailwind for stock valuations. And maybe less likely, but still possible, some kind of positive geopolitical surprise, like de-escalation somewhere or trade tensions easing significantly. That could boost global growth and sentiment.
Okay, so those are potential positives. What about the downside? What are the traps or challenges that could derail this whole optimistic picture?
The downside risks are definitely there, and they're pretty compelling too. First, simple valuation contraction, multiple compression. Given how high the PE ratio is, the market is just vulnerable. If investor sentiment sours or if interest rates stay higher for longer than people think, those multiples could easily shrink.
Right, even if earnings hold up, the price paid for them could fall.
That's exactly. Second big risk, the labor market. If it weakens more sharply than expected, if unemployment starts rising significantly, that hurts consumer spending. That would really undermine the whole soft landing idea. Then there's that concentration risk we keep mentioning. The market relies so heavily on just a handful of giant tech stocks.
The Magnificent Seven effect.
Right. If any one of them has a big earnings miss or faces a major regulatory challenge or a new competitor emerges, it could have a really outsized negative impact on the entire S&P 500 index. And finally, maybe a resurgence of inflation or trade wars flaring up again. Any kind of macro shock that pushes costs up or forces the Fed to backtrack on easing, that would be kind of double headwind, hitting both growth and valuations.
So we've really taken a deep dive here. It paints a picture of an S&P 500 that's, well, clearly defined by this strong AI-fueled growth and surprisingly positive sentiment, but at the same time shadowed by these historically high valuations and, yeah, significant concentration risk. It's a dynamic picture, maybe even a bit precarious.
Yeah, precarious is a good word. If you connect all the dots, it really boils down to this balancing act. You have to weigh that compelling long-term AI growth story against these very real immediate risks. Concentration, the stretched valuations, and now this compelling alternative sitting there in fixed income. It's just a high-stakes environment right now. The balance between those forces and investor conviction in them, that's likely what determines where we go from here.
Well, thank you for walking us through all that. It's been a really insightful look under the hood of the S&P 500 today.
My pleasure. And maybe a final thought for you to ponder. Given how much the market leans on just a few sectors, and given that significant yield advantage you can get from risk-free government bonds right now, how much conviction do you really need in that continued concentrated AI supercycle to justify paying today's premium for stocks? Especially if that growth doesn't broaden out quite as quickly as everyone seems to hope.
That is a great question to chew on. Thanks again. And thank you for joining us. Keep exploring, keep thinking critically about the markets.